It's another edition of the Trading Tips video newsletter, teaching you how to become a successful trader today. This video newsletter is brought to you by firsthourtrading.com.
Welcome to this edition of the TradingTips.com video newsletter. In this episode, we'll be looking at the brewing conflict between Amazon and Apple and what it means for the future of those stocks and the tech sector in general. Without further ado, let's get started. Last week, Walmart abruptly announced it would no longer sell the Amazon Kindle. The announcement was made on Thursday, and between then and the following Monday, shares of Amazon lost 2.3%. Walmart said it would continue selling the Apple iPad, and shares of Apple closed at $698.70 on the day of the announcement, and then went as high as $705 the next day. Since then, however, Apple has come down too, indicating that the price movements in both of these stocks, Amazon and Apple, have had a lot to do with things other than Walmart's announcement. Still, Walmart is the world's largest retailer, and it did make a splash with its announcement that it would not sell the Kindle, but would continue to sell the iPad. Why is Walmart taking sides? And what does it mean for the future of Amazon and Apple? When you think about it, you have to wonder why Walmart, or any other retailer for that matter, would sell the Kindle in their stores in the first place. All Kindle models are very low profit margin. In fact, Amazon sells them at a loss, sells them to retailers at a loss and to customers at a loss. Why does Amazon do this? Because the Kindle is a device designed to sell Amazon content and Amazon products. This not only means ebooks and music, which compete with Walmart's physical sales of the same items, but actual physical merchandise from Amazon.com. Selling the Kindle actually helps make more Amazon customers, and this doesn't make sense for Walmart or any other retailer. The Russian communist revolutionary Vladimir Lenin said, "The capitalists will sell us the rope with which we will hang them." And while Lenin was wrong about most things, he did seem to predict the short-sightedness of many of today's multinational corporations. Best Buy, for example, is a fledgling company, having lost much of its sales to Amazon and other online retailers, and yet Best Buy, still sells the Amazon Kindle in its stores. Worse yet, many people simply visit Best Buy or Target or other stores that sell Kindles just to physically touch them and get to see them. And then they go home and order the item on Amazon. In essence, what these brick and mortar retailers are doing is giving Amazon the one thing it doesn't have, a physical presence. And they're doing it all for a very small markup. It's not smart at all. Speaking of companies being short-sighted, another example is Barnes & Noble, once Amazon's principal competitor, but now a stock on death watch. Its Nook promotes the idea of electronic books, which is in direct opposition to Barnes & Noble's basic business model. Can B&N transition from a bookstore to a technology company? You might say, well, Amazon did it, but Amazon was different from the beginning. It was a technology company that happened to sell books, not the other way around. Apple is Amazon's real competitor, a technology company that happens to sell music in this case. So let's look at Amazon and Apple head to head. Last quarter, Amazon saw its EPS fall by 98%, while Apple saw its grow by 20%. Clearly, the stocks aren't even in the same league when it comes to earnings growth. In raw earnings, Amazon posted a net profit of just $7 million last quarter compared to $8.8 billion for Amazon. So where are the two firms competing anyway? Well, Amazon is a sales powerhouse, posting sales of $12.8 billion last quarter, which was 20% improvement over the same quarter last year. Apple's $35 billion in sales, however, were up by 23% compared to the same quarter last year. Both companies, it should be noted, have zero debt. So it may seem as though Apple is the stronger play of the two here, since it has greater sales growth and much greater earnings and EPS growth. However, Apple is a nearly mature company, whereas Amazon is still in high growth mode. In fact, Apple's recent lawsuits against Samsung and other mobile phone makers symbolizes a shift towards a more conservative, less growth-oriented strategy like that of Microsoft. Apple is the company it's going to be. Amazon has not yet reached its peak. Walmart taking sides with Apple just shows that they're both old world interests, while the new world is Amazon's. Shares of Amazon are currently trading in the $250 range. I like them at any price $250 and under. My first price target is $270 per share, at which point I will sell half my position and let the other half ride. From there, I will use a rolling stop loss based on the highest price Amazon reaches, minus 8%. This will lock in profits while letting my potential winnings grow indefinitely. Initially, I'll use a stop loss of $230 per share, but I will adjust it higher once I hit my first price target. We hope you've enjoyed this TradingTips.com video newsletter. Thanks for watching and good trading.
This Trading Tips video newsletter has been brought to you by Manny Bacchus's First Hour Trading System. Every day there's money to be made in the first hour of stock trading. This is the world of day trading, not for novices, unless you have a system. The First Hour Trading System. Visit firsthourtrading.com now and sign up for a free 30-day trial. You could make enough in the first hour of your day to take the rest of the day off. View more Trading Tips videos. Visit tradingtips.com. Sign up for our free video newsletters and become a successful trader today.